Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week I will go over the charts of the S&P 500 index and the New York Stock Exchange Advance decline line ending December 31st, 2018. In addition, I will also review the international developed stock markets. After that, I will go searching to see if there are any indices that may be trending up. And finally, I end the video with what does this mean? Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk including loss of principal. The first chart I will be showing is a 3-month daily chart of the S&P 500 ending December 31st, 2018. I will be using a 200-day moving average as the key trend line to give us a baseline of the health of the S&P. If you remember in previous videos, this moving average is used by traders as a long-term trend indicator. Price above it is a positive sign, while price below it shows weakness. Looking at this chart, we see that the S&P is below its key moving average, which is not good. It had been in a tight trading range since mid-October until mid-December when that range was broken on the downside. So what can we say about the S&P from this chart? Well, it is not healthy, but it still can recover and get back into bullish territory. In a previous video, I showed that early in a pullback, if the S&P can hold and consolidate, a recovery is possible. But it will need to hold the lows of 2018. We recently had a good bounce back rally, but it will be all for nothing if in the next pullback it breaks below 2346. In this chart, I show the NYSE Advance decline line. As a recap, this index is a breadth indicator based on net advances, which is the number of advancing stocks less the number of declining stocks. I will use the exact time frame and indicator to let us know where this index stands. As we can see here, this index, like the S&P, is below its 200-day moving average, which shows us weakness in the market. The NYSE Advance decline line is closely correlated to the S&P, and thus this index gives us confirmation that the S&P weakness is broad-based. Here we have the MSCI EAFE index. It follows the Developed International Stock Index. And using the same time frame and indicator, we see that this index has been below its 200-day moving average before October. It has attempted several rallies, but has failed each time and gone lower. The key lesson of this chart is just because we may have rallies in an index, it does not mean a new uptrend is beginning. Trying to predict a bottom, especially in a market that is below its 200-day moving average, can be harmful to your portfolio. The important question is, are there any indices that are trending up? And despite the popularity of the S&P and other US stock indices, it does not mean we should not look for other indices or assets. We should always be flexible and open-minded because the US stock market will not always be in a bull market. So let's see what we can find. The first index we will look at is the US 10-year Treasury Note. This is an oldie in our videos as we have been watching it make progress trying to get into a bullish uptrend. And what we see here is that since its move above its 200-day moving average, it has had small pullbacks, but has bounced back stronger. Another possible key to a sustained uptrend is to see if the 200-day line begins to slope up. Though we are very early in the process of this index proving worthy of being a strong asset, it has shown positive signs so far. Another index that I have demonstrated in my videos is the Gold Continuous Contract Index. Now this asset has finally gone and stayed above its 200-day moving average for several days. That is a positive sign. Now a pullback will be needed to test the strength of this rally, and the trend line would need to begin to slope up. But for those gold bugs out there, this is at least something to follow. Our final index that is showing possible signs of strength is the CNX 500 index. This is India's broad-based stock market index that represents about 96% of India's total market cap. Now here we see this index flirting with its 200-day moving average. In fact, it did close several days above it before pulling back. Now, unlike the previous two indices, this one is only in the flirtation stage. It has yet to open and close at least one day above its long-term moving average. But what it does tell us is that at least one country's index is close to an uptrend. There is still a lot of work to be done, and it could also possibly mean that its 200-day moving average is a key line of resistance. So while there is potential here, it is only potential, yet something to keep an eye on. What does this mean? Despite the S&P recent rally, the big picture has not changed. The index is still under pressure as prices below its 200-day moving average. Couple that with the NYSE Advance decline line also below its 200-day moving average, and we do have some serious concerns about the health of this index. But we are still in the early stages of this pullback, so there is still a chance that this can be a standard drawdown. But patience will be needed, as the longer it stays in weakness, the more downside pressure can occur. The international developed markets fell below its 200-day moving average before the U.S. equity markets and has failed to stop its downward slide. This is the exact reason why I stayed with the S&P. Try and be patient, not to attempt to pick a bottom because things could go lower. Now, the S&P and other U.S. equity indices may dominate headlines, but that does not mean there are no other assets or indices worth looking at. I showed you the US 10-year Treasury Note is beginning to enter a new possible uptrend. Gold and the Nifty India 500 index are trying to follow suit. Both of these indices still need time to prove themselves. The key is that there are other indices to look at for uptrends, even if the S&P and other US stock indices are in a downtrend. I would like to thank you for viewing this video, and I hope it was helpful. Please subscribe to my channel for future videos.